best ways to make money from investing. Investing isn't exclusively for the ultra-rich anymore. In fact, one of the most common ways for regular Americans to become millionaires is to invest in the stock market. Investing can feel intimidating with all the different investment opportunities available to you. And if you're new to investing, you may not know what you're doing. No matter what your goals are, whether it's saving for retirement or putting money away for a down payment on a new home, we all have goals, and your success relies on what you invest in. It's not only a matter of picking successful stocks or deciding whether to invest in stocks or bonds, it's making the best investing decisions possible depending on your goals. Or to put it another way, when you'll be relying on the profits from your investments. Let's look at some of the best ways to make money from investing in more detail. This may not be suitable for you at this time, but the best investments for your needs can shift with time. So let's get started. 1. Stocks. If you're looking to build wealth over time, owning stocks is perfect for you. U.S. stocks have better returns than other investment opportunities, and almost every decade in the last century has seen stocks outperform most other investment types. The reason why stocks do well is that you essentially own a business as a stockholder. You own a business that grows in value and becomes more profitable as the world economy grows. If you're unsure how much of your investment portfolio should be allocated to stocks, you can try this method. Subtract your age from 110. It's as easy as that. This is the percentage of your investable funds that should be invested in stocks. The remainder should be put into fixed income securities like bonds. Then, depending on your risk tolerance, you can increase or decrease this percentage. Consider the following scenario. You're 35 years old. According to this approach, you should invest 75% of your available funds in stocks and the remaining 25% in fixed income. You could adjust this ratio in favor of stocks if you're a risk taker or expect to work past the usual retirement age. If you don't like huge fluctuations in your portfolio, you could change it in the opposite direction. As a shareholder, you can also earn a dividend. Dividends are lower-risk investments, where shareholders receive monetary payments from the company's profits. These payments provide investors a stream of income that can either be reinvested to buy more shares or paid directly into the investor's account for their personal use. This is why most people's portfolios should be built on stocks. 2. Bonds. Growing your wealth is one of the most important steps over the long term. However, once you get closer to your financial goals, bonds can help you keep your wealth. This is because bonds are loans to the government or a company. There are 3 types of bonds available: corporate bonds, which companies issue, municipal bonds, which state and local governments issue, and treasury notes, bonds and bills, which the U.S. government issues. So, how do bonds work? Bonds are a type of investment that allows a company to raise funds. Let's imagine your city invites you to make a financial investment. In exchange, your city pledges to reimburse you for your investment plus interest over a set period. For example, you could invest $5,000 in a 10-year bond with a 3% interest rate. In exchange, your city promises to pay you interest on that $5,000 every 6 months and then return it to you after 10 years. Bond investments can be profitable in 2 ways. The first option is to keep the bonds until they reach maturity and earn interest payments. Interest on bonds is normally paid twice a year. The second strategy to earn from bonds is to sell them for a higher price than you paid for them. Bonds are a fantastic approach to diversify your portfolio and safeguard yourself from market volatility if you're heavily invested in stocks. 3. Real estate. Owning high-quality real estate can be a great way to build wealth and is a more stable and safe investment than stocks. However, you shouldn't consider your primary residence as an investment. Think about commercial buildings and apartments that you own and then lease out. Most real estate can appreciate over the years, but you rely on tenants' cash flow to make money off your property. To make real estate investing profitable, you need to charge rent that's more than you pay in taxes, maintenance, and your mortgage. If you can't afford to buy a property and lease it out, consider rates. a more accessible way to invest in real estate. REIT stands for Real Estate Investment Trust and is publicly traded on the stock market like other public companies. Example of REITs include Avalon Bay Communities, one of the largest apartment and residential property owners in the United States. Public Storage owns nearly 3,000 self-storage properties across the U.S. and Europe. REITs are excellent sources of income. If they pay out a minimum of 90% of net income in dividends, they don't have to pay corporate taxes. Index funds are a passive investing method that can monitor hundreds of different indexes. The most popular is the S&P 500 index, which includes 500 of the largest companies in the United States stock market. Despite plummeting 35% in a 6-week period in February and March of 2020, the S&P 500 returned a spectacular total return of 100% in the 3 years from 2019 to 2021. Over the last 3 years, an investor holding the SPDR S&P 500 ETF would have seen their investment double in value. You don't have to be a stock market expert to make money investing in index funds. It's simple and effective, and you can turn your investment into a substantial nest egg in the long run. 5. Mutual funds. A mutual fund is a bundle of investment assets packaged together to form a single investment. Investors can pool their money to invest in a diverse portfolio of bonds, stocks, and other assets through mutual funds. Let's look at a few things you need to consider about mutual funds. To begin, you must know the difference between an actively managed and a passively managed mutual fund. An active mutual fund has managers who choose the fund's investments. A passive mutual fund merely replicates the performance of a benchmark index, such as the S&P 500. An active mutual fund goal is to outperform a specific index, whereas a passive mutual fund's goal is to match it. As a result, index funds are another name for passive mutual funds. Secondly, the majority of mutual funds have minimum investment requirements. So before you invest, double-check the fund's minimum requirements. Mutual funds are a terrific way to invest over time without worrying about choosing individual stocks and bonds. 6. Tax-advantaged accounts. Because you must consider tax implications on your investments, where you invest is just as significant as the types of investments you own. Your investment portfolio should include tax-free investments for you to benefit from. Each investment caters to certain types of accounts based on what you're investing for. Let's look at a few examples. Roth IRA, for those who want to save for retirement. Traditional IRA, for those who want to save for retirement. 401k, for employees who want to save for retirement. SEP IRS, Solo 401k, for self-employed individuals who want to save for retirement. 529 college savings, for those who want to save for college. Coverdell Education Savings Account, ESA, for college savers. Taxable brokerage, for savers with extra funds to invest beyond the demands or constraints of their retirement or education savings accounts. When investing in one of these tax-advantaged accounts, you need to consider the following. Employer-based 401k plans should be used to the full extent possible, at least up to the maximum amount that your employer will match. Building up tax-free income in retirement is a wonderful method to help ensure your financial future if your earnings enable you to contribute to a Roth IRA. Using the Coverdell and 529 college saving plans, Roth-like benefits eliminates the tax burden, allowing you to put more money towards education. The best method to minimize permanent losses is to invest in a diversified portfolio that does not have too much of your money invested in a single company, industry, end market, or investment type. Diversification can help protect you from permanent losses while increasing your exposure to wealth-building stocks. Each person's situation is unique. To make the best investment decisions to meet your financial goals, you must consider your investment timeline, expected return, and risk appetite. We have many resources for you to learn how to retire comfortably and live a financially free life. If you'd like to learn more about personal finances and how you can make money through various investment methods, subscribe to our channel to receive notifications of our latest episodes.